Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, with Shaun Burgess, Portfolio Management Strategist, one of our chief analysts over in Bondland, which is right around the corner there. So November 14th, really closing in on the end of the year. Got a little dose of volatility the last 10 days, last 3 weeks, Shaun. I wanted to share a great chart before we shoot over to bonds, just to give some perspective of where we sit equity-wise from a historic standpoint.
Great thing to keep in mind too.
With volatility.
Context,
So take a quick look at this chart, and we'll have Christopher, our crackerjack videologist, keep this up there for a moment. What we're looking at here is on the top a chart of the most consecutive trading days for the S&P 500 within 3% of all-time highs. Okay, so that means there's been a persistent bid, right? Amazingly, there's only been 6 longer streaks, Shaun, going back 75 years. So we're talking about a thick data set, right? We see data and charts and analysis all the time with paper-thin data sets, trying to make a case for what's going to happen.
Yep.
All we're sharing with you today is how unusual it is to get this type of persistency in a bid in the markets. Now, take a look at the chart on the bottom. The NDX, NASDAQ 100, doesn't have quite as rich a history, but we can still go back 32, 33 years.
That's not too bad.
All right, and when we look at the NDX, it's the 3rd longest streak at most consecutive days within 5% of all-time highs. Okay, when you think about what we've gotten used to the last 3, 4, 5 months is tranquility, right? The bid has been there. We've been flirting with highs, pushing ahead. So when we get a dose of volatility, it at times feels worse than it really is.
It can be jarring. It can be very jarring.
Because we're all victim to recency bias. You hear me talk about that all the time. One of the biggest flaws for an investor or a trader, one of the things they need to overcome is that recency bias. So I bring this up to show how strong the bid or the buy or the demand has been for equities. I'm going to add this because people may look at these charts and say, boy, that must mean we're going to fall off a cliff. If you look at the years on these charts and take a look at, 6 and 12 and 18 months after these streaks, the market was just fine.
Yeah, it's important to keep in mind.
And I bring this up because persistency doesn't tend to fall off a cliff. It rotates. So absolutely, can technology get ahead of itself? Can large cap growth get ahead of itself? It can. Maybe it has a little bit in here, Shaun. I'm not sure. We'll let the we'll trade what's in front of us. We won't make too big a prediction there. But here's my point on persistency and rotation. And I know you're a bond guy, but I'm still going to put you on the spot. And I want our viewers to think through this for 10 seconds as well. Don't look it up. Just answer to yourselves. The last 30 and 90 days, so 1 month and 3 months, what are the 2 strongest sectors of the 11 S&P sectors?
Technology and... I'm on the spot for the second one. That one's a tough pull.
Okay.
Technology's taking the crown there.
That's a great shot. Great shot, Shaun.
Banking?
You're wrong on both.
Oh.
So what we're
not
talking,
my finest moment.
And I'll guarantee 90% of our viewers don't get this. And my point is, it talks about rotation. The 2 strongest sectors the last 30 and 90 days. Number 1, healthcare, led by biotechnology. Number 2, you ready for this? Energy. Take a look at that on your charts. Take a look at that, or you can trust me. I've looked at it and trade it daily.
Those are my second choices, by the way. I was just about to say those.
All I'm doing in mentioning that is that we tend to get dominated by what's been working. And we see tech having a little bit of a muddy patch here. And although earnings were great, so were expectations. So there's a little
pretty high.
A little reset, right? Semi's a little pressure. And I say a little. Listen, we've only backed off a little bit.
We were talking about that this morning.
Some of the garbage, some of the stuff that never should have been bid to where it is has been chopped. But when we look at good, solid, tech, large cap growth, yeah, have they pulled back 3%, 4%, 5%? Sure, that's normal, and normal as rain, right?
Yeah.
So my point being, I'm trading this in our current view that the volatility is more a view of rotation than it is of money exiting the market into cash, or exiting the market into short-term bonds, or exiting the market to get defensive. Yep. If there was one thing I want to keep an eye on is I have to respect here, Shaun, that when defensive sectors start to lead, it is probably a message that I have to respect that the market may not have as much oomph to the upside, right?
A little bit of flight to quality, a little bit more of a safety trade.
Yeah, so we'll see. But my point being, let's not get ahead of ourselves here just because we got a little dose of volatility. Yeah, all right. Bonds were a little bit quiet this week, but I'm sure you still have a little bit of news for us.
Oh yeah, this is where I get to shine. So bonds were quiet, as you said. You had all the volatility. We had a holiday midweek, Tuesday, right? It was Veterans Day. So it kind of derailed maybe what you'd see as follow through. So on the bond side of things, very quiet. The Treasury was off higher in yield by 3 to 5 basis points, right? It's really been, that 10 years really been range bound. We talked about that 4 to 415 level. We briefly touched through 4 post September and October cuts. We briefly touched to about a 395. Market couldn't hold it. Went all the way back to a 415, and now we've kind of settled right in that kind of what I'd call a 410 kind of band, right around 410. And we really need more data to drive further through that. We talked about this, I think, the last time that we were on. We have the government reopening this week, Wednesday. Right. That thankfully came to an end. The shutdown came to an end. So we should start to get the flow of data back to what we're used to, and the market kind of can get a little bit better idea of direction, so we can maybe get a little bit of a tailwind to bring us back down through 4%. But we really have to see some help on inflation. Labor, we know we've seen the weakness, but it depends on where you're looking at for that labor weakness. So we really need to see some help on inflation, and we can hopefully get that as we move into the next opportunity for the Fed to cut, which will be December. That's going to be the next Fed meeting where they can make an adjustment. Right now, the market's telling you about, or at least the market's about a 43% chance of a cut. So under 50-50, and our own outlook had about a 50-50 shot, really dependent on what happens with tariffs and inflation. That's going to be the major driver short term. So we should start to see a little bit more data this week. Munis, decent week for munis, a little bit of outperformance, another week of decent inflows. So continue to see that support municipals. So it was a pretty decent week for munis and rates all around, considering where you are on the equity side of things.
Right. Good information. That churn to the bond market, maybe on the bond side, you'd like to see a bid and rates go lower. From a broad multi-asset approach, I don't mind a churn to the bond market. That 380 to 420 on a 10-year, that lets investors win a lot of ways, right? Yeah. They can win with coupon and yield. Mm-hmm. It's probably that those rates aren't restrictive to equities. It may not even be restrictive to commodities. It may be a way to allow a multiple allocation portfolio to work in a few different fronts. So, okay, appreciate the time. We went a little long, but I did want to cover some of that data because I think it's important when markets start to get choppy. Enjoy the weekend. We'll see you next Friday.